Yo, Brian here. Let me save you a headache. A lot of people ask, how do lenders calculate my buying power? And this is a great question because your buying power is not just what you make at work. Lenders are looking at the full picture just to see how much house you actually can afford and how much they're willing to lend you. Here's a simple breakdown. 1, your income. First, they look at your gross income. That's your income before taxes. This can include salary, overtime, bonuses, commission, self-employed income, and certain other qualifying income sources. But here's the key. They don't just ask what you made last week. They want to see if your income is stable and documentable. So if your income goes up and down a lot, they're going to average that out. 2, monthly debts. Then they look at what you're paying for monthly, what your monthly payment look like, your subscription, well, not subscriptions, but car notes, credit cards, things like that. Student loans, personal loans, child support, alimony. These are your monthly debt obligations. Like you have to pay these. This matters because lenders is calculating your debt to income, DTI, debt to income ratio. So that's basically how much of your monthly income goes towards debt before even adding a mortgage. The more debt you have is the less room for a house payment. 3, credit score. Your credit score plays a big role too. Why? Because your score can affect a whole bunch of stuff. For example, your loan options, your interest rate, and sometimes how much you qualify for that's comfortable. Strong credit gives you better terms, which then gives you more buying power. A lower score, again, can qualify you for a loan, but the payment's going to be higher because of the rate and costs. 4, your down payment. Down payments matter more than people think. A bigger down payment can reduce your loan amount, reduce your monthly payment, and sometimes just improve everything overall. It just makes everything work. And then that's how you get better approval rates. Number 5, interest rate. This is a big one. Even if your income stays the same, your buying power can change because of an interest rate. Why? Because lenders qualify you based on the monthly payment, not just the sales price. So when rates go up, payments go up. And when the payments go up, your max price will more than likely go down. That's why somebody that qualified a whole different amount a month ago, and you're just like, wait, you told me I can get 300,000. Why do I only qualify for 250 now? That's because the rates changed. Number 6, property taxes, insurance, HOA. This is where people get bent out of shape. Lenders don't just calculate principal and interest, although those are the main players. They also factor in full housing payments, which includes HOA if you're in an HOA community, mortgage insurance, property taxes, homeowners insurance. So 2 homes at the same price can have dramatic difference in monthly payments because of HOA and insurance. Taxes as well. That means your buying power can shift based on the neighborhood too. And number 7, last but not least, the loan type. Different loan programs have different guidelines. FHA, USDA, VA, conventional. Each one have a different requirement for, credit, down payment, debt to income, mortgage insurance, how much reserves you need, etc. So your buying power may look different based on the loan product that fits your needs the most. So let's say 2 buyers both bring in $100,000 a year. Same monthly income. Sandra has low debt, better credit, and money saved up. While Jessica has higher monthly debt, maxed out credit, well, not maxed. Let's not do that. Let's not do Jessica like that. But lower credit score and less money for down payment. Mind you, same income, but they may not have the same buying power. But a lender is going to tell you the truth and the raw truth, nothing but the truth, so you can get a realistic picture of what you can buy. So if you're wondering how much house you can actually afford, don't guess based on your income alone. Your buying power is really based on, your income, yes, but debt, credit, down payment, interest rate, HOA, taxes, insurance, loan. There's a lot of factors that factor into this thing. If you want, send me a message so we can get prepared the right way, so you can go into the market with nothing but firepower. You know exactly what you need, what you want, and you can just, go in equipped, confident, and not confused. It's your boy Brian. See you on the next video. Peace.